Good morning and welcome to our webinar. Today's topic is tax application of relevant taxation principles and legislation with specific focus on charitable institution under Section 44 subsection 6 of the Income Tax Act 1967. This topic is highly relevant because charitable institutions play a vital role in supporting social welfare, education, and religious activities in Malaysia. The objective of this webinar are to explain the legal framework governing charitable institutions, to demonstrate the practical application of tax exemption and compliance, including recent update by LHDN. This webinar will be presented by three speakers. Let us begin with our first speaker, Faiz.
Thanks to our moderator. So today I will explain what actually is a charitable institution means under Malaysian tax law, also the types of such institution and how much they must spend to be eligible for tax income exemption. A charitable institution is actually a non-profit organization that has a sole intention to relieve poverty, provide education, propagate religious activity, promote cultural activities, or any activities that can bring benefits to the society. So there are several types of charitable institutions such as religious institution, cemetery management, and international schools. This entity may receive income from donation, rental of praying hall, member subscription fee, or any others as stated in the Act. The income may only be used for non-profit purposes only. However, this institution may venture into business for the purpose of sustainable fund to continue their charitable activities. So if they use less than 25% of the accumulated funds for business purposes, they may need to use at least 50% of the previous year income on charitable activities. However, if they use between 25% to 35% of the accumulated funds, they need to spend at least 60% of the previous year income on charitable activities. If they fail to comply with this requirement, they may result to revocation of the charitable institution, and the income of the donation may be subject to the tax. And the income may also subject to income tax if the recipient of the donation or contribution is engaged in business, or the donation or contribution received are used to increase revenue and to sustain its business activities. As in LHDN Practice 2025 of Sekolah Setia Bakti, the institution provide education to children with disability and have received donation from public which are collected by the school. The donation is used to finance fee, and the donation will be used to increase its revenue and therefore will be subject to tax under paragraph 4A. And also that is full of my explanation, and I will pass to our moderator.
Faiz for the insightful information. Now, let's move to our next speakers, Zain, to explain more on this section 44 subsection 6 and section 33 subsection 1.
Okay, thanks to our moderator. Okay, today I will explain about section 44 subsection 6 and section 33 subsection 1. Okay, according to section 44 subsection 6 of the Income Tax 1967, is a tax exemption incentive given to institution for meeting the approval condition in the provision of the law and regulations set by KPHDN. Institutions that have been approved by KPHDN under this provision get two benefits. First, income tax exemption on all income received by them under paragraph 13, subsection 1, schedule 6, and the second one, donor are eligible for tax deduction in tax competitions subject to 10% under section 44 subsection 6 from aggregate income, except donation or contribution to the government, state government, and local government. According to section 33 subsection 1, of the Income Tax 1967 provide that tax deduction will be given for expenses wholly and exclusively incurred in the production of gross income. The word wholly and exclusively refer to the requirement for a sole intention behind the incurrence of the expenditure to be established, while the phrase in the production of gross income require a direct nexus or connection between the incurrence of the expenses and the earning of income. In short, an expenses must be incurred solely for the purpose of producing income and not merely for any business related purpose in order to qualify for a tax deduction. Okay, for example, Yayasan Jayadiri was established to manage public fund for charitable purpose and receive donation from the public, but is it not an approved institution of public character under Section 44, Subsection 6 of the Income Tax Act 1967. In the year of assessment 2024, YG received total donation of 200,000 and incurred expenses amounting to 165,000 for a charity dinner, contribution to flood victim, food basket program for the homeless, and operating expenses. These expenses are allowable deduction under Section 33, Subsection 1 of the Income Tax Act 1967, as they were wholly and exclusively incurred for the foundation charitable objective. The remaining surplus of 35,000 was not fully utilized for charitable purpose, and since YJ is not approved under Section 44 Subsection 6, the surplus is taxable as income under paragraph 4A of the Income Tax Act 1967, and the income is not eligible for tax deduction in tax competition subject to 10% from aggregate income. Okay, that's all from me. I will pass to our moderator.
Thank you, Zaim. Now, let's move to our third speakers to tell us about the current practice applied by the LHDNs.
Thank you, Luffy, as our moderator today. I got a new tax concept for the approval granted on or after 27 November 2025. According to the recent policy announced by the Inland Revenue Board of Malaysia and according to the recent policy announced by the Inland Revenue of Malaysia and reported by the Ads Malaysia, approval granted to charitable organisation under Section 44 Subsection 6 of the Income Tax Act is now limited to a maximum period of 10 years. Once this approval period expires, the organisation must reapply for continued tax exempt status. If the approval is not renewed, any income received thereafter will be subject to income tax. For example, Yayasan Prihatin is a charitable institution that receives public donations. In 2026, the foundation is approved under Section 44 Subsection 6 of the Income Tax Act. For the next 10 years, from 2025 to 2035, the donations received are tax exempt, and donors are allowed to claim tax deduction. However, when the approval expires in 2036, and if the foundation fails to renew it, any unutilized surplus of donation will be treated as taxable income under paragraph 4 subsection A of the Income Tax Act. That's all for me. I will pass to our moderator, Luffy.
That brings us to the end of today's webinar. Thank you to our speakers for the great insight, and thank you to everyone who joined us. We hope you found this session valuable. Have a great for the rest of your day, and we look forward to connecting with you again soon. Thank you. Before working on this project, all four of us viewed taxation mainly as a technical subject, focusing on calculations, rules, and examination requirements. Tax exemptions under Section 44(6) were initially seen as straightforward benefits granted to charitable organizations. However, after researching the topic in depth and examining current LHDN practices, our understanding changed significantly. From a personal learning perspective, we realized that tax exemption is not a permanent right but a privilege that must be continuously justified. Learning about the 50% charitable spending requirements and the 10-year limitation on approval made us aware of how closely charitable organizations are monitored to prevent misuse of public funds. From a professional perspective, each of us gain different but meaningful insights. One of us develop a deeper appreciation of how taxation is used as a policy tool to support public welfare rather than merely a method of collecting revenue. Another reflected on the importance of governance and compliance, especially how internal controls, pure documentations, or misuse of funds can lead to revocation or non-renewal of tax exemption. One particularly important reflection came from understanding the ethical responsibility involved in managing charitable funds. Handling large sums of money carries significant trust. This made us realize the need to control ourselves, act with integrity, and avoid any form of corruptions or personal gains. As future professionals, learning and upholding ethical standards is essential to ensure public confidence in charitable organizations. Another member realized the importance of staying updated with budget announcements and LHDN administrative practices, as changes in enforcements, such as time-limited approvals, may not always be immediately reflected in textbooks. Overall, this project transformed our understanding of taxation from being rule-based to responsibility-based. We now see tax law not just as a regulation to follow, but as tools to protect public trust and promote ethical conduct. In terms of self-improvements, this project has helped all of us grow both personally and professionally, especially in how we view responsibility and decision-making in taxations and charitable activities. Before working on this topic, we generally assume that organizations labeled as charitable were automatically trustworthy and that donations made to them would always be used for good purposes. We also did not think deeply about the responsibilities of donors or professionals when dealing with tax-exempt entities. After learning about Section 44(6) and studying current LHDN practices, our mindset changed. One important lesson shared by our group is the need to be more cautious before donating money. Even if an organization appears to have good intentions on the surface, poor internal control or unethical management may lead to misuse of funds. This made us realize that donors should ensure the organization is properly approved under Section 44(6) and complies with LHDN requirements. Another key improvement is our increased awareness of due diligence and ethics. We now understand that both donors and professionals play a role in preventing abuse of tax incentive. Blind trust can lead to unintended consequences, especially when large sums of money are involved. Professionally, this experience has prepared us to assess whether an organization truly complies with tax exemption conditions, understand the importance of transparency and governance, and apply taxation principles such as substance over form and accountability when giving advice. Overall, this topic has improved our readiness to make responsible financial and professional decisions, ensuring that charitable intentions are supported by proper compliance and ethical conduct. In conclusion, charitable organizations approved under Section 44(6) of the Income Tax Act 1967 enjoy significant tax benefits, including income tax exemptions and tax-deductible donations. However, these benefits come with strict responsibilities, such as compliance with Schedule 6, meeting their minimum 50% charitable spending requirement, and adhering to the 10-year approval limit under current LHDN practice, with renewal subject to reassessments. These requirements reflect key taxation principles of equity, accountability, and substance over form, ensuring that tax incentives are granted only to genuine and well-managed charitable organizations. That's all from us. Thank you.